So yeah, we did announce results this morning. Certainly last year was challenging. I think for every real estate company, whether you were pure real estate in Asia or the US or Europe, you had a choppy 12 months. Higher interest rates, geopolitical tensions made it significantly difficult for all of us. I would say when we looked at our results, there are two components, as you mentioned. Really is our fee-related business and our real estate investment business. Our fee-related business actually performed much stronger than we thought it was. And, we made a conscious effort to pivot 2 years ago, to restructure to be more of a fund manager and less of a property developer. And that fee-related business is shown exactly the value we wanted in a situation like last year. When interest rates were up, valuations came down, the recurring fees we got from fund management, from lodging management, commercial management, really helped sustain our results. Without that, we've been in a very different situation today. So by getting to crossing that 1 billion mark in fees for the first time for us, that gave us a steady recurring stream of income, which allowed us to keep our dividend consistent this year. We did face fair value losses, as you mentioned, and that was really on now what has actually become the smaller part of our business, which is the real estate investment side. Unfortunately, with higher cap rates, slower growth projections, we saw impact in the US and in China in regards to our fair values. Fortunately, they're non-cash in nature, but still did have, as you mentioned, significant impact on our total profits. But I think because of the recurring part of the business, and that's the part we're still pushing to grow, it gave us confidence to announce, as you mentioned, a new funds under management target. And we're hoping over the next 5 years that we can double that business.
And I want to get to that funds under management target that you've actually set, but I do want to talk first about the China exposure, because when you talked about the revaluation losses, some of it was actually linked to the lower rental revenues in China, the cost of these revaluations. Tell us what you're seeing now with regards to the Chinese property sector, because it's on the lips of anybody who's concerned about what's going on in the global economy and the knock-on effects. Just how cloudy or how choppy has it been to navigate the property sector in China, and are the concerns about the commercial sector there and other segments of the real estate sector in China indeed something that people should probably pay a bit more attention to?
I think people have been paying attention to it for quite some time. Unfortunately, China's been challenging. We've been there for the last 30 years, so we've seen up and down cycles like this before. Unfortunately, this one over the last 12 months has really put our team to the test, and they've been really working hard to optimize our portfolio there. We've had exposure across different sectors: retail, office, logistics, data centers. I would say last year, we saw numbers across most sectors come down. Chinese New Year, though, these last few weeks surprised us. We saw a very good footfall in our retail malls. We saw more spending by consumers. We're hoping that is a bit of the direction that we're headed. So I would say we're still very watchful on how China is going and how retail spend and office tenants may behave. But I think when we look at that, we know over the next 12 months, it's going to have its ups and downs. So as a group, what we are doing is we're focusing on the 70% of our portfolio outside of China. As we discussed a little bit earlier, Singapore is great for us. Singapore's been doing really well. India's been doing well. And I think as we look at this in entirety, we're hopeful that these other areas can grow at an even faster clip and make up for the more challenging environment in China.
So, Paul, let's talk about this goal now to double your funds under management to about 200 billion Singapore dollars in 5 years. And you also have an asset recycling program at the moment. How are these two particular programs linked, if they are actually? And what do you think are some of the key factors and principles that guide asset recycling and also your efforts to expand your funds under management to about 200 billion Singapore dollars in the next 5 years? It's a bit ambitious, sir.
It is a little bit ambitious. I think that's why we're very excited to talk about it. We had a 100 billion target for this year, and we're pretty much on track that we'll hit that 100 billion this year. So the goal now is 5 years down the road. We wanted a target that was both ambitious but realistic. So it's ambitious enough that we think it motivates the company, all of us as employees in the company, to really drive the growth of the company. But we want to make sure we're not driving growth for growth's sake, right? For us, having high quality earnings for our LPs and our investors is the most critical thing. So we wanted a number that we thought was actually realistic and achievable. And when we look at the different parts of our fund business, we have our listed division, which is about 60 billion funds under management. Our listed division has, the largest in Singapore, and it's always grown pretty steadily. Right, last couple of years were challenging, but an easy 8 to 10% organic growth is something that division can achieve. We're putting a lot more effort behind our private funds, which is about 40 billion, 39, 40 billion funds under management. That's the one we really need to kickstart to see faster growth. But between the two, we think we can get a pretty good pickup already from that 100 B up to a decent number. And then we've always talked about filling the remaining gap with M&A, inorganic growth, really to fill capabilities we lack in certain geographies or certain asset classes. So when we think together with the organic and the inorganic growth, that 200 is something that we can get to, but also is ambitious enough that we've got to work for it.
And just quick